The tariff war can be considered to be on a temporary truce. In addition, inflation in Australia has just begun to ease. On May 20th, the Reserve Bank of Australia, RBA, announced a 0.25% interest rate cut, bringing the official cash rate down from 4.1% to 3.85%. This marks the second rate cut this year and brings the rate to its lowest level since May 2023. The RBA has made it clear that the inflation outlook continues to improve and there is room for further rate reductions. Australia's 4 major banks also predict that this rate cut cycle may include between 3 to 5 times cuts, totaling as much as 1.5%. With global central banks easing monetary policy, whether you're looking to buy your first home or invest, now is the time to take advantage of the lower interest rates. Lower rates not only help reduce mortgage repayments, but also improve borrowing capacity. Banks are loosening their lending standards, which in turn lowers financing costs. This presents one of the more valuable opportunities to enter the market in recent years. The current rate cut cycle is poised to reshape the investment landscape. So how exactly can we make the most of it? And how should we structure an investment portfolio during this environment? That's what we'll be breaking down in detail in this episode. Hi everyone, I'm Alison from Australia. My channel focuses on Australian lifestyle, personal finance, and real estate. I'm one of the few licensed professionals in Australia who holds qualifications in both accounting and law, while also working as a real estate agent. My team and I are committed to helping you build high-return, tax-efficient investment portfolios to fully protect your wealth. I'm also the author of Buying Property in Australia for Financial Freedom. Please note that everything I share here is based on personal opinion and does not constitute financial advice. If you're interested in one-on-one consultations, you can visit investwithalison.com and book a session that suits your schedule. On May 20th, the RBA announced a 25 basis point cut to the benchmark interest rate, in line with market expectations. The RBA also issued a statement noting that since the peak in 2022, inflation has significantly declined, largely due to high interest rates effectively rebalancing supply and demand. The latest annual inflation rate is 2.9%, marking the first time it has dropped below 3% since 2021. Inflation is expected to remain within the RBA's 2 to 3% target range over the coming year. However, the RBA board is maintaining a cautious stance, warning that global economic uncertainty has increased over the past 3 months. While recent tariff news has led to a rebound in financial markets, there's still uncertainty regarding the scope of these tariffs and how other countries will respond. One of Australia's big 4 banks, NAB, predicts the current rate cut cycle will continue into early 2026, with a total of 5 rate cuts reducing the cash rate to 2.6%, a full 1.5% drop. In comparison, CBA, Westpac and ANZ forecast 3 cuts this year, bringing the year-end cash rate to around 3.35%. After enduring years of high interest rates, many people are relieved to see the start of a rate cut cycle. When interest rates are lowered, most people naturally think about saving on their home loan repayments. But what many don't realize is just how significantly lower rates can impact them financially and how they can be used to build a strong real estate investment portfolio. Firstly, rate cuts ease repayment pressure. For example, with a $600,000 Australian dollars loan over 25 years, a 0.25% rate cut reduces monthly repayments by approximately 92 Australian dollars, saving about $1,104 per year. If NAB's forecast of 5 rate cuts comes true and the rate drops by 1.5%, monthly repayments would decrease by $526, saving 6,000 Australian dollars annually. This is a great time to speak to your bank or financial institution about refinancing. See which banks are offering the lowest rates and best deals. Every bit saved is money in your pocket. The second benefit of falling rates is improved borrowing capacity. Lower rates not only save money, they also allow you to borrow more. According to the managing director and head of research at InvestorKit, each 0.25% drop in interest rates can boost borrowing capacity by 2 to 3%. What does that mean? For instance, a young couple earning a combined 150,000 Australian dollars might originally be able to borrow 700,000 Australian dollars. After a 0.25% cut, they could borrow 720,000 Australian dollars. If rates fall by 1.5%, their borrowing capacity could increase by over 10%, allowing them to borrow $770,780,000 Australian dollars. This could be a game changer for those who have been just shy of entering the market. Please note, this example is based on one bank's lending model. Every bank calculates differently, so if you're unsure, it's best to consult your own mortgage broker. Even a small increase in borrowing power could help someone finally buy their first home or help an investor borrow more to expand their portfolio. For investors looking to grow their property holdings, interest rate cuts not only ease repayments, but can also create refinancing opportunities. Although Australia's property market has been heating up recently, high interest rates in recent years made it hard to cash out on gains. That may now be changing. After refinancing, many people use the equity to purchase a second property. More experienced investors, once their property has appreciated, often leverage their increased equity. Combined with falling interest rates, which improve borrowing capacity and lower financing costs, they find it easier to refinance, particularly through what's called a cash-out refinance. This allows them to extract equity from existing properties and reinvest it into new assets. But what exactly is cash-out refinancing? Simply put, it involves reassessing the value of your property. If your property has appreciated, you can ask the bank for a new valuation. Based on the increased value, the bank may allow you to take out a larger loan. The difference between your current loan balance and the new approved loan amount can then be withdrawn as cash. For example, if you bought a property 3 years ago for $500,000 Australian dollars and put down a $100,000 deposit, you would have taken a loan of $400,000. If that property is now worth $600,000 Australian dollars and your loan balance has reduced to $380,000, your equity is now $220,000 Australian dollars. The bank may allow you to borrow up to 80% of the new value, $480,000 Australian dollars. After paying off the existing $380,000 loan, you could potentially access $100,000 in cash, which can be used as a deposit for your next investment property. I've also created a detailed guide on refinancing in Australia. If you're interested, feel free to leave a comment or send an email to marketing@rightkeyinvestment.com and we'll send you a free copy. However, I don't recommend this strategy for everyone. It's not risk-free and isn't suitable for all investors. In fact, for some, it could be very dangerous. So before talking about the benefits, let's look at the potential risks. Constantly refinancing is not without its downsides. This strategy requires a high degree of financial independence and detailed planning. If you significantly increase your loan amount but your cash flow can't keep up, you may end up under heavy repayment pressure, which can trigger a financial crisis. That's why you should consult with a qualified mortgage broker and accountant before proceeding. Be sure to calculate your monthly expenses and understand your household's financial limits. Just because a bank approves your refinancing doesn't mean you can afford the repayments. If you can't repay, the consequences can be serious. If, after thorough calculations and advice from independent professionals, refinancing still makes sense, then the current rate cut cycle presents a rare opportunity. You may be able to borrow more while also lowering your financing costs. In recent years, I've worked with many clients in Brisbane who have benefited from this strategy. Their properties appreciated significantly, and they refinanced to extract cash, which they then use to invest in properties in other growing markets like Western Australia. In just a year or two, especially in booming markets like Perth, which has seen growth of 20% or more annually, these clients achieved further gains. Many are now preparing to refinance again to reinvest in other high-potential cities. This interstate investment strategy, leveraging growth in one market to fund purchases in another, is how many investors take advantage of different property cycles. They transfer capital from mature markets to emerging ones, rapidly growing their portfolio like a snowball. In a few short years, some have gone from owning one property to 2, then 2 to 4. One key advantage of refinancing is that it allows you to unlock gains without selling the property, meaning you don't have to pay capital gains tax. You're simply using the equity created by appreciation as a funding source for the next growth phase. It's a powerful strategy for building your property portfolio and generating passive income. You may ask, how long can I keep refinancing? That depends on your borrowing capacity. Once your borrowing limit is reached, the strategy no longer works. Plus, every time you cash out, you'll be increasing your loan amount and repayments. If your cash flow can't handle the increased debt, I would advise against continuing. For those with strong borrowing capacity and stable cash flow, the question then becomes, when should I stop? The answer varies from person to person. Everyone's definition of financial freedom is different. Some people may only need 2 fully paid off properties generating rental income to quit their jobs. Others might need 4. So, as you build your property portfolio, always keep your end goal in mind. How many debt-free properties do you need to achieve your version of financial independence? For instance, if your goal is to eventually own 2 debt-free properties, and you've built up a 5-property portfolio, you could sell 3 properties during a boom to pay off the remaining 2. And that could be your financial freedom moment. But again, everyone's financial situation is different. Financial freedom is not the same as being rich. It means your passive income covers your living expenses, even if you choose not to work. That's why it's essential to consult your independent mortgage broker and accountant before taking any action. Never implement a high-risk strategy without professional advice. If you're interested in investing or have questions, feel free to leave a comment below. If you'd like to book a one-on-one consultation, feel free to WhatsApp or email me or visit my website at investwithalison.com to schedule a time. Thanks for your time, and I'll see you next time. Bye-bye.